Welcome to the Deep Dive. Today, we're tackling Cisco's Q1 fiscal year 2026 earnings. They just came out November 12th, 2025.
Yep, fresh off the press.
And our mission really is to pull out the key numbers, sure, but also get under the hood what's really driving things for them, especially now with all this AI talk.
Right, the why behind the numbers.
Exactly. So let's dive right in. Top line results. This was, well, a clear beat and raise, wasn't it?
No doubt about it.
Adjusted EPS came in at $1 per share. Analysts were looking for, what, 98 cents?
That's right, 98 cents, so a nice beat there. And that dollar figure is up 10% year over year.
When revenue also beat, $14.9 billion against $14.77 billion expected.
And that $14.9 billion, importantly, marks an 8% increase year over year. You know, the context here is pretty critical.
Go on.
Well, this is the fourth straight quarter they've grown revenue compared to the year before.
Yeah.
Remember, prior to this run, they had 4 quarters of declines.
Ah, right. So this kind of confirms the turnaround isn't just a blip, it's got legs.
Seems like it. The momentum is building.
The market certainly thought so. The stock popped, what, about 5% after hours?
Yeah, immediate positive reaction. But, you know, I think the guidance is where the real story is.
Okay, yeah. It wasn't just a small beat on the current quarter. They raised the outlook pretty significantly. Tell us about that.
Exactly. The confidence really shines through in the forecast. For Q2, the current quarter, fiscal 26, they're guiding revenue between $15.0 billion and $15.2 billion.
15.0 to 15.2. And the street was expecting.
The average estimate was way down at $14.6 billion.
Wow. Okay, so that's not just nudging it up. That's a substantial raise. What's underpinning that kind of confidence?
We'll get into the drivers, but it signals strong order trends and visibility. And it's not just revenue. The profit outlook is strong, too.
Right, the EPS guidance for Q2.
Non-GAAP EPS. They're expecting $1.01 to $1.03. Again, beating the consensus, which was at 99 cents.
And the full year, did they bump that up too?
They did. Full fiscal year 26 revenue guidance is now $60.2 billion to $61.7 billion. Analysts were modeling closer to $59.7 billion. And full-year non-GAAP EPS raised to $4.08 to $4.14 versus the $4.04 expectation.
So across the board, higher expectations for the rest of the year. They're essentially saying, look, this isn't just a good quarter. The whole year looks better.
That's the message. The momentum feels locked in.
Okay, so let's unpack that. If the confidence is structural, like you said, what's driving it? The earnings call, the reports, they all seem to point heavily towards AI infrastructure demand.
Absolutely. It's the dominant theme. You can see it in the order numbers. Total product orders grew 13% year over year. Pretty solid across the board.
Okay.
But the real standout, the number that jumps off the page, is the service provider and cloud segment. Orders there were up 45%.
45%? Whoa.
Yeah. When you see growth like that, it screams hyperscalers. They're building out networks like crazy.
Makes sense. The networking segment itself, their biggest unit, that was the engine, wasn't it?
It really was. Sales climbed 15% year over year, hit $7.77 billion. And maybe more importantly, this is the 5th quarter in a row they've seen double-digit growth in product orders for networking.
5 straight quarters. So this isn't just like one big order. It's sustained demand. It feels like AI is forcing upgrades.
That's exactly the read. They can't get the performance they need for these new AI workloads from the old gear. Cisco even quantified it a bit.
How so?
They specifically called out taking $1.3 billion in AI infrastructure orders just from hyperscalers in Q1.
1.3 billion in one quarter just for AI from the big cloud guys.
Yep. And they said it was pretty balanced between their specialized Silicon One systems, those are the high-performance chips and routers, and the optics, the high-speed connections.
Okay, $1.3 billion is a big number for a quarter. But, you know, for a giant like Cisco, is that truly transformative on its own? Or is there a risk these hyperscaler orders are kind of lumpy, maybe one-off big builds?
That's the crucial question, right? Is it sustainable? And I think the reason the guidance was so strong and the market reacted positively is the trajectory they laid out.
Okay.
That $1.3 billion, that's just Q1. They're forecasting $3 billion or more in AI infrastructure revenue from hyperscalers for the full fiscal year 26.
$3 billion plus for the year.
Yeah. And they expect AI-related orders for the full year to be at least double what they got in fiscal 25. That provides some visibility, suggests it's not just a one-quarter bump.
Okay, that context helps, that kind of longer-term expectation that feels more structural. The CEO, Chuck Robbins, he made a pretty bold comparison, didn't he?
He did. He basically said, The speed of this AI transition feels like the internet boom back in the late 90s. Explosive, almost nonlinear growth.
That's a powerful analogy. It's just a fundamental shift.
And they're backing it up with specific tech. They talked about the new Cisco 8223 router. It's powered by their Silicon One P200 chip.
Yeah.
This isn't your home router. We're talking 51.2 terabits per second. It's designed specifically for that intense, constant AI traffic between data centers.
Industrial strength bandwidth, basically.
Exactly. It signals the requirements have fundamentally changed.
So that covers the immediate AI surge. But the other really interesting angle from the sources, maybe even more foundational, is this multi-year campus refresh cycle they kept emphasizing.
Yes, this is huge. They talked about a major multi-year, multi-billion-dollar campus networking refresh cycle that's kicking off now.
And why now? What's driving that?
It's largely driven by obsolescence. They have this massive installed base of older switches, specifically the Catalyst 4K and 6K lines. Tens of billions of dollars worth of gear out there.
Okay.
And that gear is hitting its end of support date. Customers literally have to upgrade. There's a built-in timeline forcing this spending over the next few years.
So it's partly just replacing old stuff that won't be supported anymore, a mandatory upgrade.
Partly, yes. But it's also about capability. They highlighted that their new gear, smart switches, secure routers, the new Wi-Fi 7 stuff, it's all ramping faster than previous product launches ever did.
Faster adoption. Why?
Well, beyond just the EOL issue, the new platforms embed security much more deeply into the network itself, and that's becoming critical.
Why more critical now?
Because of where AI is heading.
Yeah.
They talked about agentic workflows. Think complex AI tasks where multiple AI agents are working together. These workflows apparently generate up to 25 times more network traffic than today's chatbots.
25 times. Wow.
Yeah. You need robust, embedded security at the network level to handle that kind of load securely and efficiently. So the upgrade is both necessary for support and for future capabilities.
That paints a picture of pretty unavoidable, urgent spending for enterprises. Does this show up in their forward-looking metrics like backlog?
It does. Look at RPO, remaining performance obligations.
Yeah.
That's basically committed future revenue from contracts already signed. Total RPO grew 7% to almost $43 billion. And product RPO, the hardware and software licenses part, was up 10%. That tells you customers are already committing to these upgrades. It provides a solid revenue base moving forward.
Okay, so networking and AI are clearly the stars here, but we need the full picture. What about the other big segments? Security, for instance. That one actually looked a bit weak, didn't it?
It did on the surface.
Yeah.
Security revenue fell 2% year over year to just under $2 billion,
Right.
and it missed estimates, which, seems counterintuitive given everything we just said about security being critical.
Right. How do they explain that, especially with Splunk now integrated?
Yeah, and it ties directly to Splunk. Management gave some really crucial context. They said the decline was basically a timing issue.
Timing issue. How?
It's about the shift to the cloud. Customers are apparently moving really quickly to Splunk's cloud subscription offerings, faster than expected.
And that hurts revenue now.
In the short term, yes, because cloud subscription revenue is recognized ratably spread out over the life of the contract, whereas the older on-premise deals often had more revenue recognized upfront when the deal closed.
Ah, okay. So more cloud adoption is good long-term, but it creates a temporary dip in reported revenue because of the accounting change.
Exactly. That's the argument. Is a JAP revenue headache now? Definitely short-term pain point for investors who just look at the headline number.
But management is spinning it as positive overall.
They are. They view the rapid cloud shift as ultimately better for customer adoption, for expansion, for stickiness. And they pointed out that Splunk's ARR, annualized recurring revenue, and his product RPO still grew double digits.
Okay, so the underlying subscription business for Splunk is still growing strongly, even if the reported segment revenue took a hit due to the cloud transition model.
That seems to be the case. Investors seem to buy that explanation, given the stock reaction. They're willing to accept the short-term accounting noise for the long-term cloud story.
Got it. That's an important clarification. What about the collaboration segment, WebEx and devices?
That one continued to struggle a bit. Sales slipped 3% to about $1.06 billion, also trailing estimates. It seems like declines in both their physical devices and WebEx itself are still a drag.
Still a tough market there.
Yeah, but it's a smaller piece of the overall Cisco pie compared to networking or security now.
True. Okay, last check. Any big macro risks or headwinds they flagged? Even with the strong guidance.
They did mention a few potential challenges. Potential tightness in the supply chain, especially for some key components needed for AI gear, like high bandwidth memory and optics. That could constrain things if demand really spikes.
Makes sense. Anything else?
And just the general macroeconomic pressures. While the hyperscalers are spending big, broader enterprise spending, could still be sensitive to economic uncertainty. So they're optimistic, but keeping an eye on that.
Okay, so let's try to synthesize this deep dive then. Cisco comes out with a strong Q1, beats expectations, raises guidance pretty significantly, and it feels like it's powered by, really, two massive structural forces colliding. First, the urgent need for AI infrastructure, particularly from the cloud giants where Cisco plays a key networking role.
Yep, that's tailwind number one.
And second, this almost perfectly timed, multi-billion-dollar campus networking refresh cycle, driven by old gear finally needing replacement just as new security and performance demands are rising.
Exactly. A mandatory upgrade cycle meets a capability upgrade cycle.
So what's the big takeaway here? What does this really signal for the broader landscape?
Well, I think the bottom line is that high-performance, secure, scalable networking, it's not just nice to have IT spending anymore. For big companies, especially those wanting to leverage AI seriously, it's becoming viewed as almost existential.
Existential, that's a strong word.
Yeah, but think about it. If you can't run the AI models, if you can't handle the data securely, if your network becomes the bottleneck, you fall behind. So they're funding it aggressively now. It's seen as critical infrastructure for future competitiveness.
Yeah, that makes a lot of sense. Okay, so as we wrap up, here's something to think about. Building on what the CEO said, he mentioned AI workloads aren't just bursts of traffic anymore. They're becoming persistent high-intensity loads.
Right, a fundamental change in traffic patterns.
And he said that reality demands infrastructure and compute power move much closer to where the data is generated closer to the edge. So the provocative thought for you, the listener, is this. How fast will that shift force every large enterprise, not just the hyperscalers, to adopt new edge solutions? Think about things like Cisco's unified edge platform to handle real-time AI inferencing right there in their own facilities, on their factory floors, in their branch offices. Could that forced shift to the edge be the next massive spending wave, pushing these upgrades even further?
A really interesting question. The campus refresh might just be the beginning.